Today, we're going to dig into a really provocative idea that's shaking up how people think about the venture capital world. A recent analysis has come out with this new framework, and it suggests that some of the biggest names in the business, well, they aren't actually playing the game we thought they were. So let's get right into it, starting with a one sentence that kicked this whole thing off.
Okay, let that one sink in for a second. This isn't really an argument about their success. I mean, that's obvious. It's about their strategy. The whole point is that the game they're playing has fundamentally changed. And look, this isn't just a shot at one famous firm. This idea applies to pretty much the entire class of mega funds out there. You know, the ones that might have started as traditional VCs, but according to this new model, they've evolved into something else entirely.
So that's the big question, right? If venture capital is the wrong label for these giants, then what on earth are they?
Well, the answer really lies in splitting the market into two totally different categories. And this isn't just about playing with words. It's about understanding two fundamentally different ways of investing that are just, operating under the same umbrella.
So here's the new term, consensus capital. And honestly, the best way to think about it is it's like big finance, but it's just got a Sand Hill Road address. It's less of a treasure hunt for some hidden gem and more like a Wall Street strategy. These massive funds aren't really making small, risky bets on unknown founders anymore. They're deploying huge amounts of cash into the companies that pretty much everyone already agrees are the winners.
And this is where you can really see the difference. True VC, it's messy. It's an early, conviction-driven bet on something that might not work. That's what you'd call an alpha strategy. You're trying to outsmart the market. Consensus capital is the total opposite. It's about paying a premium to get a piece of the obvious winners, the ones the market has already given a big thumbs up to. You're not trying to beat the market, you're just trying to ride its wave. That's a beta strategy. They are two totally different products, just being sold under the same name.
Okay, so you might be thinking, who cares what we call it? Well, it actually matters, a lot. Because when we keep calling both of these things venture capital, it has real tangible effects on everyone in the tech world. First up, let's talk about the LPs, the limited partners. These are the pension funds, the university endowments, the family offices that are pouring billions into these funds. They're the customers, right? And for any customer, knowing what you're actually buying is, well, it's everything. If you're an LP, you have to be asking yourself, what am I really buying here? Am I signing up for the super high risk, but potentially explosive returns of a true VC fund that's betting on the unknown? Or am I buying into a consensus capital fund, which has a totally different risk profile because it's basically just investing in the industry's pre-vetted obvious winners?
All right, so that's the investors. But what about the founders, the builders? Let's flip to the other side of the table, because this whole distinction doesn't just shape expectations for investors, it creates two completely different realities for the people trying to raise money.
What's happening is that two totally different fundraising paths are opening up. If you fit a certain profile, you went to an elite school, you worked at a top AI lab, capital from these huge funds is basically flowing your way. It's abundant. But if you're what you'd call a non-consensus builder, you need to know your path is different. You're not looking for consensus capital, you're on a quest for one of the remaining true VCs, the ones who still specialize in those gut-feeling, conviction-driven bets. Okay, so we've got the investors and the founders. But what about the big picture, the whole ecosystem? The language we use shapes how we see the health of the entire industry. And right now, the data is getting kind of messy. And this isn't just some abstract idea, by the way. Industry analysts are seeing this split in the actual data. Peter Walker over at Carta calls it the bifurcation of venture capital. Bifurcation, it just means a splitting into two. A great divide is literally forming right under our noses. And it makes sense when you think about it. When a billion-dollar consensus deal gets lumped in with a tiny seed investment, all the data gets warped. Benchmarks for fund size, for round size, they all get skewed. And that's what leads to these confusing headlines about an existential crisis for smaller funds. But if we just separated the two categories, we'd get a much clearer, truer picture of the health of both the established giants and the up-and-coming VCs.
So where do we go from here? What's the path forward? Well, it's not about choosing a winner. It's actually much simpler. It's about seeing the world more clearly. Look, the point here isn't to say one is good and the other is bad. It's just to recognize that consensus capital and true venture capital are two different coexisting strategies. They serve different parts of the market. And by simply treating them as distinct, everyone, from investors to founders to analysts, gets the clarity they need to make better decisions. Everyone is better off.
So we'll leave you with this to think about. As the industry keeps splitting in two,
Are we stepping into a new era where getting access to capital is less about the disruptive power of your idea and more about the pedigree of the person who has it? It's a huge question, and it really gets to the heart of what the future of innovation is going to look like.